All right, let's look at one more example of the equity method. Taking into account the fact that we are considered a significant owner of this company or influencer of this company, therefore it's as if we have to bring their assets on our books. So if there's any difference between the fair value and the book value, we may have to account for the possibility that there would be additional depreciation. In other words, had we physically bought all of this company, when we pull their assets into our company, we pull them in at fair value, not the company's book value. So therefore, if we pull an asset, let's say they have an asset for $10 million on their books, but when we buy it, that asset would actually be worth $11 million because it's a factory, it's gone up in value just because of inflation or whatever. We would bring it on at $11 million and then depreciate at $11 million, not $10 million. So that extra $1 million in value would cause us to have more in depreciation expense for that period of time. Or for an intangible, we'd have more in amortization expense during that period of time. So depending on the type of asset that we bring into our company, we may end up having more in depreciation or amortization type expenses. So when we're looking at the equity method, we have to take that into account as well, because that would impact our overall equity in that company, because we would actually have less in income as a result of greater rates of depreciation. So Pfizer Pharmaceutical paid $80 million on January 2nd for 2 million shares of Crane Cosmetics common stock. The investment represents 25% interest in the net assets of Karn and gave Pfizer the ability to exercise significant influence over Karn's operations. Pfizer received dividends of $3 per share on January 21st, and Karn reported net income of $52 million for the year ended December 31st. The fair value of Karn's common stock at December 31st was $30.50 per share. The book value of Karn's net assets was $208 million. The fair value of Karn's depreciable assets exceeded their book value by $32 million. The assets had an average remaining useful life of 8 years. The remainder of any excess of the cost of the investment over the book value of the assets purchased was attributable to goodwill, which is not actually amortized anyway, so we don't have to worry too much about that. All right. Prepare the journal entries for the purchase through the end of the year. So let's start with January 1st, actually January 2nd here when we purchased these. So January 2nd is when we're going to go in. We bought 2 million shares of Karn stock and we paid $80 million. So again, this is a significant influence, so we are going with the equity method here. So we're going to do investment in equity affiliate. We're going to record that at the $80 million cost. And then we're going to go do our cash account here. And our cash account for 80 as well. Just like before, this is an asset exchange. So assets are going both up and down by the 80. Statement of cash flows, we're looking at an outflow of 80 million, and this would be from investing activities. So an outflow of investing. All right. Then, just like before, when you're in the equity method, you do record your portion of their net income because their equity increases, so therefore our claim, also their assets should increase as well because you would have cash or receivables created from that income. So, $52 million, we would go in and increase our investment in the equity affiliate for our portion of the income, which in this case would be, let's see, 52, we own 25%, so that would be 13, I believe, if I'm doing that correctly. So y'all, hopefully it is. If not, you yell at me. And then we record that as investment revenue for this period. So we're going to go in and hit our investment revenue for the 13 as well. Our assets are going up and our equity is going up. Just like before, we've already done one of these. That is a revenue to us, therefore our income goes up. Now this would not be an inflow or outflow of cash because there's no cash involved. We're simply recording our portion of. So we don't have to record that. Just like before, dividends reduce the equity of the company in which we're investing in. So therefore, when we receive the dividends, we're simply going to reduce our investment in the equity affiliate from that perspective. Now, we are not physical owners, so if the stock goes below, if the value goes below zero, then we would stop recording. You would not have a liability situation. As the owner of stock here, we wouldn't be liable for covering, so the most we could ever lose is our investment. So you do want to make sure that your investment account doesn't go negative, because you can't have a negative investment in a company. So that would be sort of a little bit of a situation there. Different way to treat it, but that's not going to be the case here. So how much in dividends? Well, let's see. They reported $3 per share. We own 2 million shares, so 2 times 3 would give us 6 million in total dividends. And that's what we would record. In that, dividends reduce equity, therefore it should reduce our investment. So we're going to take our our assets down by 6, and we're going to take our assets up by 6. This is actually an exchange. I don't know what I'm doing with my typing there, but anyway, so cash goes up, our investment goes down. This is a cash event, so we are getting a cash inflow of 6 million in dividends. Typically speaking, that would be operating. Again, you could make an argument for investment depending on type of dividend. We will not talk about that right now. Dividends, typically speaking, are operating under GAAP. Now, other. What's this other? Well, keep in mind, if we brought this in as an owned company, we'd bring those assets in at fair value. So since their fair value exceeds their actual book value at this point, we will have to calculate how much an additional depreciation we would take had we actually purchased this company outright. So let's see, the current depreciable assets exceed their book value by 32 million. So we're going to start there. Since they exceed 32 million, we actually own 25% of that. So you're going to do 32 million times 25%. That means that our portion of the assets would be 8 million in additional depreciable assets. So again, there's 32 million in total. We own 25%. So 25% of that 32. So if we just go over here somewhere and say, hey, 32 million times 25% means our portion of that increase in fair value of assets is 8 million. So had we brought this onto our books, we would have recorded additional assets of 8 million versus what the current Karn Cosmetics has it recorded at. As such, that 8 million would add over the life of 8 years an additional $1 million in depreciation expense. So stop and think about that. If they had an additional $1 million in depreciation expense each year, their income would have been less. So instead of reporting the income of 13 million, they would have only reported income that was our portion of 12 million. So what do we need to do? Well, we need to go in there and adjust it for that. So we're going to reduce our investment revenue by the 1 million. There, between the two entries here, we're creating that $12 million inflow. Had we purchased this company outright, we would have more in depreciable assets, which would make our depreciation expense greater for the year. Therefore, that reduces our investment revenue, our revenue of the overall company. And then we're going to also reduce our investment in our equity affiliate by the 1. We would do that for each period until we sold this actual asset. Okay? So that's bringing our assets down by 1, and it also nets with that to bring us down to 12 in total change in equity. In that would be a reduction of a revenue. I want to put a negative revenue here just because I want you to see that, hey, the net of these two should be 12 in total change. Okay, so if you add those two together, you get that 12. When you reduce that, that would give us a loss of income of 1. Again, there's no payout here. There's no cash being received or paid out. So therefore, we would not hit the statement of cash flow. And just like before, there's no fair value adjustment. And I put that in there just to prove that point. You're like, well, why do you even include it? Well, you have to stop and think. When you're in the equity method, you have to understand that there's no fair value adjustment. You're already marking the investment to your ownership in the equity of the company. So therefore, you do not need to mark it to fair value, because the fair value of a company's stock does not change their actual equity on their balance sheet. All right. So again, just keep in mind, if our depreciable assets are different when we would have purchased the company and brought them on at fair value versus the book value that they're currently carrying them at, that would have created additional depreciation for our company as a combined entity. So therefore, you would have had additional depreciation expense that does reduce your investment revenue, because the company would not have reported 52 million in total revenue that year had they had more in depreciation expense. All right. That wraps it up for the equity videos. If you have any questions, let me know.